Good everyone. Welcome to this briefing where we're going to be looking at what's happening in the area of fuel, which obviously is an extremely topical at this moment. We have a fantastic panel assembled here. We have Eleanor who's joined us from S&P Global, expert in fuel markets. We have Hemant Mistry, who's our director in charge of fuel and energy transition, and we have Owens Thomsen, who needs no introduction at all, but she is our Senior Vice President for Sustainability, as well as Chief Economist. We're going to have a short presentation, a couple of slides from IATA, a few more slides from S&P, and then we will throw it open to the floor for questions. And again, we have translation, so if you need translation, we have these. If you put it on green, it means you're getting translation into English. And if you put it on red, you'll have translation into Portuguese. So with that, I'll throw the floor to Hemant.
Thank you, Tony, and good afternoon to everybody. So I'm going to start off, as Tony mentioned, just with a couple of slides of introduction. And for those of you that joined us yesterday for the SAF and Net Zero briefings, they are the same slides, but I want to re-emphasize some of the points and also to set the scene for the presentation from S&P Global, because I think it's quite important. So if we just move ahead, this is a slide I showed yesterday, and this was really to illustrate where we are in terms of those jet fuel prices. But first, if we just concentrate on the blue line, which is of course the price of crude, in this case Brent, and there you can see how that has developed since the closure of the Strait of Hormuz. And just in terms of numbers, when the strait was closed, we saw that the crude price increased to around $120 to $125 per barrel. And that did subside somewhat, but still at a very elevated level between $95 and $115 a barrel. But what you see in terms of the other lines, of course, are the benchmarks for jet fuel across the regions, and there you really see the price dislocation. And the bigger difference now you see, which has evolved between jet fuel and the price of crude. And this is, of course, very problematic for the airlines. So the increase in terms of jet fuel prices has been at a different level. And just in terms of comparison, if we look 6 months ago, the average jet fuel price was $96 a barrel. And in April, it had doubled. It had actually doubled to $188 a barrel. In May, it has subsided again, but again, it's still at a very elevated level of $156 a barrel. So that's where we are right now in terms of overall impacts. And just to re-emphasize, jet fuel has been disproportionately impacted compared to crude, but also to diesel and to gasoline as well. And all of this means that there is a lot of volatility in the market, a lot of impact to the airlines. It's all driven by the loss of export flows, logistical bottlenecks, and also in terms of refining constraints as well. So this price location is really the issue itself, and that's what has an increase and pronounced impact on the airlines. And to explain part of the reason, and I do emphasize part of the reason why this is happening in terms of the price elevation, is the reliance on imports. And as I explained yesterday, 3 regions we can see from this chart have a heavy reliance on imports. And of course, you can see here it's Europe, Africa, and Latin America. But if you concentrate on the yellow bar, which is really the import from the Persian Gulf, then you can see that it's really Europe and Africa. And in terms of percentages, 24% of the jet fuel consumption for Europe comes from the Persian Gulf, 33% comes from the Persian Gulf for Africa. So the need for imports and so on has become more pronounced in certain regions, particularly in Europe, because as Owens Thomsen mentioned earlier today as well, there's been a reduction in refining infrastructure in regions like Europe. And if we just look at the jet output in Europe, we've seen that the level of jet output as a refined product in Europe, including the UK, decreased by 13% when you compare to pre-COVID levels. But if you just look at the UK alone, we're looking at 42%. So it gives you an illustration of the increased reliance there has been in certain regions. And of course now that impact is being felt with the closure of the Strait of Hormuz. Now, having said that, I do want to emphasize that there's been a lot of work across the supply chain to try to find and compensate those lost barrels. So we've seen increased output from refineries particularly in the US, but also from West Africa, and we have seen some output and increased output from Europe as well. We've seen new import flows, which has helped, and we've seen the release of strategic petroleum reserves and so on. So this has helped mitigate the problem to the extent possible. There has been some level of demand destruction, but this is just to set the scene in terms of where we are. What we have seen happen across the supply chain is a level of what I would call supply chain adaptation, and what Marie has mentioned is global system reconfiguration to the extent possible. And we're going to see this continue. The question is how far can we go to mitigate the lost barrels? So with that, I'm setting the scene and I'm handing over to Eleanor from S&P Global to present some tools. Thank you.
Thank you, Hemant. Thanks, Hemant. So hi, everybody. What we're going to do is, basing off what Hemant has gone through in terms of setting the scene, is just have a look at what exactly has been lost in terms of oil production, refined product production. We're not just going to look at jet fuel, because as we'll see, jet fuel is obviously the kind of key product that everyone here is interested in the aviation industry, but it's only one part of the barrel when we're talking about an oil market disruption that we're looking at the moment. So we're going to look at that. We're going to just look at our outlook for how we see the crisis, the energy disruption proceeding, and then we'll have a little look at what happens, how it happens that if we can kind of come out of this, the different steps and how long kind of each step takes, just to give an idea of how long it takes to kind of get the products back to market. So, in terms of framing, just to kind of frame the disruption, the crisis, whatever you want to call it, we started off with a disruption to flows. So trade flows stuck in the Strait of Hormuz, ships that couldn't move. This could be relatively short-lived, right? If it had ended quickly, it's just a trade for crisis, everything would have gone back quite quickly. Yeah, that's better. But obviously that didn't happen. So then what happens is we move into a supply disruption. So not just the tankers are stuck, but the crude production, the tanks, storage tanks inside the Strait of Hormuz, inside the Middle East Gulf start to fill up. So the crude production has to shut down because it can't continue producing when the crudes are not leaving. The refineries have to reduce their production because they can't keep producing when the products cannot be shipped out. And then you have the question of damage, so the missile attacks, because this is a war and there are attacks going on within the Middle East Gulf, has damaged some infrastructure for crude production and refining. So what you have is disruption to supply. After that, and where we're going at the moment, is into demand disruption. So we move from kind of flow disruption to supply disruption into demand disruption. Demand can be curtailed, disrupted by affordability, so high prices. It can also be disrupted by availability, so lack of supply. And that's what we're looking at the moment, is moving into a period where this can start to happen. A brief look, a bit more scene setting, of what we've lost since the start of the war. So you have several categories here. Oil production, so that's crude oil production, refinery runs in the Middle East Gulf as well, which I mentioned have fallen because of having to close down that production. Exports of crude oil and refined products have fallen really sharply, obviously, because the product and the crude cannot move. And then transits. So before, if we're looking just at transits of crude and product tankers, we're at about 25 per day before the war, and now we're down to a few. Essentially, almost no transits at all per day. In the Strait of Hormuz entirely, there are about 120 ships were passing per day before the war. So that gives you an indication of, it's closed. There is virtually no traffic going through. Now, another part of this story is exports of oil products. So you have here, if you focus for the time being on the middle chart, which shows you jet fuel exports, so you have the blue line is 2026, obviously you can see that falling sharply. The yellow is last year, so set against last year, and then you kind of have that set against the background of a 5-year range and a 5-year average. you can see that jet fuel exports have fallen sharply from quite a high base at the start of this year. What you see is that, as Hemant mentioned, several countries have stepped in to increase exports, which means that exports haven't fallen as much as we might have expected. So obviously some of the biggest exporters of jet fuel, Kuwait, Bahrain, have their exports frozen in. Some of the other biggest exporters globally, like India, China, South Korea, have some limitations on the exports. But other countries like Spain, like the US, Nigeria, have increased their exports. So that's filled some of the gap. And the rest of that gap can be filled partly with stock levels, stocks, strategic stocks, emergency stocks, and all industry stocks that are held. Now, the issue with this is that it's not really sustainable for some of this, because if you look at then the other two charts, you have gasoline and diesel, you can see how sharply those exports have fallen out of the 5-year range. So that's a really notable fall, more so than jet, because there's been a big focus on filling the gap in jet. And as I mentioned earlier, when you're a refiner, you're not in a one product market. You can't just focus on one product. You have to also think about other products. So gasoline and diesel is a really important part of the picture. And when you see how much those exports have fallen, obviously the question comes to mind, is this sustainable, particularly for the US? The level of jet exports, how sustainable is it that that continues when refiners also have to think about supplying these other products? I mentioned stock levels, so this has been the big buffer. We've lost a lot of supply from the market. Demand has made small adjustments in aviation and jet fuel, but the demand hasn't actually adjusted down as much as supply has adjusted. So what's filling that gap? Some increased production, as we mentioned, but also stocks. So global inventories. You see here, though, a picture of, so middle distillates is jet and diesel together. The US in the middle there, you can see how much those stocks have fallen. A lot of that is coming from diesel, it's coming from jet as well. If you look on the right-hand side, ARA, that's Northwest Europe. It's a small proportion of European stocks. The reason why we only have this is because, as some of you may be aware, there's no good data at the moment for European stock levels that will show you the period since the war started. This is actually something that I wanted to raise as a problem, because we do not know how much jet fuel there is in storage in certain regions in the world. This information is not yet available. There is some data for March, which doesn't really tell much of the story. So this is something that clouds the picture, it clouds the understanding of the market, and it raises the risk of more price volatility, because without that full picture, it's very difficult to know what kind of risk actually we're facing in terms of supply availability. And then I'd also like to draw your attention to the left-hand chart, which is US gasoline stocks. Now, this is something that I think the airline industry and anybody working in jet fuel aviation should be aware of, that we're approaching, well, pretty much into driving season in the US, when there's a huge demand for gasoline, even more so this year because of the World Cup taking place. Gasoline stocks are looking there like they're falling out of the 5-year range, which is at a period when they should be very high, because they should have been built up in preparation for this driving season. Europe also has quite a strong driving season, even though Europe is an exporter of gasoline. So demand is much higher. This means that refiners will have to pivot some of the extra kind of jet fuel effort they've been making, will have to at some point pivot back to gasoline. So that's another element to focus on, I think, in this crisis. Now, one of the questions we get asked a lot is, so, okay, the conflict broke out, there was a real price spike, really high crude price, a kind of real tightening of the market. And then that stabilized. So, you know, we get asked, is this it now? Has prices come back down? Can we expect this stabilization now to last? And our response to that is actually we think it could get worse before it gets better. So we think prices could rise again. The reason for that is that the market's made some small adjustments, but I showed you the stock levels, I showed you the exports. and also suggested that US refiners who've been plugging a lot of the gap can't necessarily keep doing so for jet fuel, which suggests to us that gasoline prices will rise again, crude prices will rise again, and jet fuel prices will rise again before there's some more stability after the summer season, and demand falls back down again from the kind of peak. And that will allow stocks to start to rebuild, and some normalization of the situation. So that's an assessment of what we could be looking at the coming months. Some quite uncomfortable moments, I think, in the market could be coming up. So moving on a little bit, what happens when the Strait of Hormuz reopens? Obviously nobody knows exactly when this will happen, but when it happens, is the product instantly there? We talked about this a little bit earlier in the big picture panel discussion. Does the price instantly fall back down again? Well, no, because there's several elements to this kind of reopening that have to be considered. Firstly, there's a logistics restart. There's the tankers that are all stuck, the laden tankers that have to move out. The risk consideration there is on insurance, it's on safety. Are the ships confident enough in the safety to leave the strait that they will be able to pass? How much will the insurance for that cost? And of course that insurance price will be passed into the price of the products. It's the time that then takes. So the laden crude tankers, a lot of them go to Asia. That's some quite long journeys. Once they get to Asia, they have to be refined, they have to be processed, they have to be put onto the market as products. That's between 1 and 3 months really, until you're getting all that product back to the market. Getting the jet fuel tankers back to Europe, that's between 4 or 5 weeks, depending on the journey that takes. So during all this time, the demand is still happening, the stocks are still falling, reducing. So that has the impact on price of maintaining the price quite elevated. After that, I talked about the full product tanks within the Middle East Gulf. So the refiners, before the refineries can restart and before the crude production can restart, they have to empty the tanks or start to draw down the tanks. That takes time, and it also means that empty tankers have to come in to the strait and they have to leave again with the crude, with the product. Are they confident that it's safe to do that? That depends how the situation has evolved. Is the strait open fully? Has there been a flow of ships? Or is there kind of a stop-start? Is there still a risk of missile attacks? So this, again, is kind of a real-time lag during which prices remain elevated. It doesn't mean that this doesn't happen, that the product doesn't get to market, but it means that the price can't fall straight away because there's still some supply risk there. And then you have the crude and refinery production restart and how long that kind of takes to come back, the damage that's been done to some of the infrastructure, and then the kind of time it takes to restart the oil fields and to restart the refineries. And we're looking at kind of 4 to 5 months before that all comes back. So this is why we're predicting that prices stay elevated through at least kind of the end of this year through next year. Now, it could actually go out further than that. So what we've been looking at is a few scenarios that go out a little bit further, sort of 5-year scenarios, and how that could play out. So I won't talk through all of this. We have a few cases. The low case at the bottom there, I'm not going to dwell on. It's a case scenario that assumes that there's a kind of immediate peace deal, that everything goes very smoothly. We don't think this is very likely to happen. We're focused more on our base case, which is at the top, and then the high case, which we're calling quagmire, which kind of speaks for itself. But the base case assumes that there'll be kind of some reopening end of July into August. That's an assumption that we've made, not the crystal ball that we have. And in that case is how I've talked about in the last slide, whereby you have elevated prices, everything takes a bit of time to normalize, it's uncomfortable, the shock is quite painful, but the system is still functioning, the system is not broken. There's a near-term curtailment of demand, but demand bounces back. and we're kind of normalizing prices through 2027, 2028, gradually. Now, the high case we have here, Quagmire, is an assumption that we're stuck in this situation for a few years. This is not, I'll say again, this is a scenario, this is an assumption that we make to model a scenario. It's not that we have a crystal ball and we think this will happen. But our high case assumes that this situation can continue for a few years, and that would entail a lot more demand destruction, persistently high and volatile prices. So not our base case, but a kind of situation that we could be in if the war doesn't end, if the Strait of Hormuz doesn't open for a number of years. Just to finish on the Brent price that we have related to the base case and the Quagmire case, which essentially, as you see, that the base case is normalizing through 2028, but Quagmire assumes a high Brent price, very high, $160 per barrel, 2026, 27, and taking some time to then come back to pre-war levels. That's really related to how much crude and how much product has come off the market, has not been produced and has not been shipped to markets during this whole period. So that's it, I think.
Great, thank you very much. Very interesting presentation. I'm sure that's got lots of people having many questions. Yeah. So who wants to ask the first question?
Hiya, Lawrence Slater from The Times. You spoke about Europe being reliant on imports. I think the UK is the most reliant on imports of all of the European countries. What's your assessment of where we're at in the UK in terms of supply? Thank you.
So yeah, the UK is one of the most reliant countries on imports, also because the UK closed 2 refineries last year, so that reduced the amount of domestically produced jet fuel. I mean, there haven't been any actual physical shortages in the UK, well, at least not related to the war. So the UK is replacing a good part of its imports with imports from elsewhere, notably from the US. However, as I said, if the US can't keep up those volumes of imports, any country that is a high importer and cannot replace it domestically is still very exposed.
Okay. Other questions? Chris? Gradually move our way over this way. You'll be next.
Hi. So looking at the chart there, the base case chart, is that spike in the green base case reflective of what you think is going to happen with the US driving season as refineries transition to gasoline? And we don't seem to have heard about that concern really before. We're sort of told that, but you don't see that translating into shortages, just into a spike in prices and jet fuel prices as well, right?
Yeah, our outlook at the moment, yeah, so that reflects all our assumptions for the base case. So everything I've talked about, the US driving season, but also all the other assumptions that are going related to all the other products like diesel, which is an important product in much of the world. So that reflects everything. And no, we're not seeing physical shortages as part of this. It's more that the prices really spike. That reduces some demand, which serves to help balance the market.
This is at a time when hedges are going to fall off, though, so it could have...
Yeah, so we have the translation, so if you can wait for the mic to come across.
I did it back.
Yeah, so but that's going to coincide, that spike, with hedges beginning to fall off when airlines have found that hedging in the near term is pretty much not worthwhile. So it could have a serious impact on airlines and potentially prices again.
Yeah, I mean, terms of hedging, it's airlines are hedging over a longer period, potentially between 1 and 2 years on average, right? So it's not as though those hedges are going to fall off. It could be the term contracts they have for 2 to 3 months and so on, which would need to be renegotiated. So it's slightly different in that sense. So of course, and it also depends when the hedge contracts, which were longer term, have been negotiated. So it's like a rolling impact.
There's a question here.
Hi. We have some independent markets that produce jet fuel, like Brazil, for example. Do you believe the cost in this kind of market will be rising as the markets that need the Gulf oil crude, or they can raise down this cost to be more economic for the companies?
In which market? In which market, sorry?
I believe the Brazilian market that we don't depend on the other countries to import the jet fuel. It's below 10% we import on jet fuel, but our price rise more than 100% in 1 month, and there's no sense that.
Yeah, I mean, Latin America as a whole imports a lot of jet fuel from the US, and the US has diverted a lot of those products. So there's kind of a tug of war for trade, and it's who can pay the highest price will get that product. Countries that are not that exposed because they supply most of their product domestically are still exposed, as you say, to international market price rises because products are priced on an international basis. So yeah, there's still some exposure, but less exposure because countries that are not so dependent on imports are less exposed.
Maybe just to mention a bit more in terms of Brazil prices. So jet fuel in Brazil is priced as in terms of it's imported. It's structurally priced as if it's all imported from the US Gulf Coast. So there is a transit fee, right? There is basically a transport fee which is added on to all jet fuel which is purchased here in Brazil. But only 86% is actually sourced locally. So that's an additional cost to airlines which is really not justifiable. So that pricing formula needs to be reviewed because now, over time, Brazil is able to produce and source and provide 86% of its own jet fuel.
Okay, take a question here.
Hugues Honoré from Agence France Presse. I would like to ask a question about potential quagmire where the US wages a very long war, and we see that in their history they waged a several-year war in Vietnam, so why wouldn't they do that again? And then shortages become so severe that do you expect a scenario, a worst-case scenario, where air traffic has to go down because of the lack of fuel?
So when you have I mean, there's a lot of detail behind that quagmire kind of line that obviously is a bit too much to present everything here, but yeah, it entails extremely high prices, which has a big economic impact, and a big impact on the economy would reduce jet fuel demand, so we would expect a significant reduction in demand as part of this, yeah.
But maybe the point should be made, your quagmire scenario isn't what you're expecting to happen.
Yeah, I mean, again, I just, so that everyone's really sure, there's the base case, quagmire is a scenario, this is what we do as kind of researchers, as modelers, we model scenarios, it doesn't mean we expect this to happen. We model the possibilities, the impacts if it were to happen.
But if I allow myself to interject something that you may or may not be interested in, but I'm upset that we are so dependent on fossil energies. I want the world to have more alternative types of energies. And every time that the world has developed new types of energies, it's always been on the back of high oil prices. So I'm not saying that this is a good scenario, but it is definitely something that for sure we can see in the past has sparked innovation and creation of new energy markets. So maybe going to your question a bit, the more that we have high oil prices, maybe the more SAF production we can actually look forward to, and of course that would solve this problem.
Okay, maybe we'll come back in this direction. So, right? Mike is coming from behind. No, here, front row. Front row. No, two, right there. And then we'll do that section next.
In fact, Marie, you've just answered part of my question, which was mainly going to be about SAF. Actually, could you also say, airlines that are, like, I think like IAG, for example, say they've got 5% SAF, are they seeing any benefit from having invested early? And can I also just ask two quick technical things? Are we effectively in quagmire at the moment unless something changes? Quagmire is just where we are, but that continues, right? So is that really such an outlandish case? Also, can you just explain to me, sorry if this is a really stupid question, but I don't understand how you can say supplies will be so squeezed and yet you can't rule out shortages. Thanks.
Yeah, so at the moment we're in what we call the base case, which means we assume that it won't go to quagmire. So that's why it's our base case.
But in terms of the politics, it's just the carrying on, right?
Yeah.
Sorry, all I'm saying is the actual current quagmire is just an ongoing where we are, is it not?
If we stay in the
and
situation,
if we stay in the current situation, yeah.
Other assumptions are increased, if we stay in the situation, it entails increased attacks because the war continues, which means increased damage to infrastructure more than we have now, increased damage to refinery runs, more cuts, more reduced in production. So it's not just where we are now, but it's a development of that situation.
And the question on why, a massive squeeze but no shortages.
At the moment,
No, how can you rule that out?
yeah, at the moment we haven't had shortages because we're using stocks and we're producing more in certain regions that can produce more. So the gap is being filled at the moment, but we don't think obviously stocks go down, they're not being refilled. So that's why we see ongoing risk.
Do you see a risk of
Sorry, I seem like
In our base case, we don't have actual shortages, because we see that there will be an end to the situation and the resupply will start to come at the end of the summer.
In your base case?
That's our base case assumption,
But in
that it will
the
not
quagmire case,
continue.
there could be shortages.
Yeah.
Okay.
But demand will adjust. Adjustments will have to be made on the policy side and the demand side to balance the market.
So demand?
And on IAG, I am definitely not going to comment on any particular airline's particular strategy, but what I observe and maybe mentioned here earlier is the strange value chain that airlines live in. Yeah, airlines are here in the middle, and everybody upstream is basically a monopoly or an oligopoly, and we are therefore price takers, and downstream we have this hyper-competitive environment where every passenger in the world can discover the price. And this has condemned airlines to never be particularly profitable. We have never had a net profit margin in excess of 5%. We are now forecasting 2% for 2026. And when you never have higher profits than that, you are not able to build balance sheets that are strong enough to give you optionality in your business strategy. Yeah, you don't have enough money to invest and do new business strategies. And the airlines, there are few airlines that have strong enough balance sheets to be able to do so. But this is my nirvana scenario. I wish that all airlines had balance sheets that allowed them to take control of some bits of the supply chain where airlines are now complete price takers. And it seems to me like part of the nirvana image of our industry in the future has to be that airlines are able to insource their own fuel supply. That is definitely what I dream for our industry. If airlines can take care of their own fuel supply and free themselves from the dependency on big oil, then they would have control over their largest cost component, and that could only be a good thing. But this is utopian. Yeah. and not even particularly accessible even to rich airlines today, other than at a small scale.
Okay, we'll move over here. The lady second from the back. Thank you.
Hi, I'm Bilkis Bahari from Mistry, Malaysia. So some airlines, especially in Southeast Asia, are very cautious in their spending, so they have been hedging their fuel. But do you think that fuel hedging is still an effective tool for airlines moving forward, given the current situation?
Well, I think airlines will take it on balance in terms of where they are. And by the way, hedging is quite complicated as to whether you hedge against crude or whether you hedge against gas or diesel, or whether you hedge against a particular jet benchmark and so on. So these are all decisions which airlines will take very carefully based on where they are. So it's part of a suite of measures which they will look into. So it's hard to say, and it depends on the situation the airline's in and its capability as well. So it's very hard to recommend one particular aspect.
Other questions? Maybe in the third row?
Okay, I wanted to know, for Africa, that there is a high dependency for fuel. So I wanted to know what would be the worst case scenario if this situation continues, specifically with specifically with the stopping of the flights and this kind of thing. What would be the worst case scenario for Africa?
So in the worst case scenario case, the quagmire, as I mentioned, we do see a lot of demand reduction. So that obviously entails that some flights would be cancelled, schedules would be reduced, which does happen when there's a lack of supply. But it's not a kind of, it's not a prediction of you'll get to the airport and there'll be no jet fuel to take your flight. It's a prediction of airlines and of the entire industry having to make adjustments, and that some of that happens because of affordability concerns. So that happens naturally.
Maybe just to balance it out, what would the most likely scenario be under your base case? What would African travelers expect?
In our base case, so as I've said, we're not seeing shortages right now, and we're not predicting shortages as in total lack of supply. No issue with I've booked a flight and it's not going to take off. That's not what we're predicting at all, particularly not in the base case, because the supply adjustments that are being made and the demand adjustments that are being made are providing some balance. And our base case predicts that it will be uncomfortable because of price volatility in the next few months, but that the supply will start to return.
Would it take longer time to be back to their feet in the base scenario for the airlines?
Sorry, I didn't hear the first part of the question. Will it take longer?
Would it take longer time in the base case scenario? If, let's say, the Strait of Hormuz open tomorrow, in the base case of Africa, so how much longer will it take them to be back on their feet and flow as they prior to the war?
For the resupply, so it depends what part of Africa, because West and North Africa are very well supplied. West Africa and North Africa are two of the regions that are now supplying a lot of European jet fuel. East and South Africa are much more exposed to supply disruptions. So the supply would take longer, but they get a lot of supply from the Middle East. So when those flows start to come back to the market, is when, I don't know the exact shipping time, a few weeks, a couple of weeks from the reopening, and then with all the kind of product being pulled in different directions. So definitely several weeks before you'd start to see the supply coming back.
I just want to add to that Africa has really inefficient distribution systems, and Africa pays, under normal circumstances before the crisis, 20% more on average for its jet fuel than other regions. Yeah, so before the crisis, Africa paid the highest jet fuel prices, 20% higher on average than the industry average. And that's all, because of very complicated distribution systems, lack of collaboration, and I don't know if Hemant wants to elaborate on that, but so if you have an inefficient system that is hit by a crisis, it's obviously going to hit the most inefficient region the worst.
Yeah, I think maybe just to add, normally what normally happens is there's a constant exchange between the suppliers and the airlines. So the airlines, when they're even negotiating the contracts, they have visibility from the suppliers as to how much product will be available during whatever time, and that's part of the discussion. But there's also operational discussions between the airlines and suppliers. So it's not as though an airline is going to turn up and suddenly find there's no fuel at the destination. That should not happen. And if that is ever on the verge of happening, then there needs to be the right communication beforehand between the supplier and the airport fuel farm operator to the airline to manage the situation. So we see that very rarely happening, that there isn't that communication. And what we're trying to make sure now is that if that ever happens, that communication goes out so it can be managed by all parties proactively. So that's something which we basically make sure that information and the protocol and so on is available to everybody.
Yeah, I mean that kind of works exactly with what we see in the base case, that it can be uncomfortable and needing managing, but the situation will be manageable, both in terms of supply and with the communication that happens on the ground.
Are there other questions? Oh, yes. Okay. Yes.
Hi, Manoj Ramohan from PTI India. So in this scenario, how long can airlines continue hiking the fares and without resulting in demand destruction in terms of passengers, and passengers decide not to book the tickets that fares are high? And add to it, second question, are we going to see something like less of economy travel and more of premium people traveling, premium travelers, because considering they might have more affordability?
Well, so there's obviously no simple answer to that question, yeah? So the first question is sort of how long can airlines keep hiking the fares? Well, they will obviously do their best to hike the fares to such an extent that they can cover the costs. The day they can't cover the costs, they will, which is arguably a large number of airlines are in that situation today, where they become loss-making. And once you're loss-making, if that goes on for too long, you're going to become bankrupt. And that's in the interest of nobody, one would think. So clearly, how long can this go on? It's a question of how long the airlines can survive. Yeah. And as we have said before, the average observed behavior is that airlines take 50% of oil price increase, jet fuel price increases on their slim margins, and they pass on 50% of jet fuel price increases to passengers. That's industry average over the long historic periods that we can observe. And I would also want to point out that if you look at the real price of air travel since 1944, there's basically no year where it hasn't gone down. Yeah. So over history, airlines, and air transportation has become cheaper for everybody everywhere. And ticket prices have not kept pace with consumer price inflation, nor has it kept pace with oil price increases. So, I'm not accusing you of having suggested this yet, but I nevertheless feel triggered to say that I don't really understand why somehow it's sometimes suggested by some people, not by you, that it's unfair that airlines put up ticket prices, whereas, obviously you have a very disrupted tomato harvest season, and everybody understands that the price of tomatoes is going to go up. I think our passengers understand it.
Yeah, I was going to say, in our passenger survey, if you have a look at the Outlook document that we circulated earlier, it does make reference to the fact that I think it's 83 or 86% of passengers understand that air tickets will fluctuate with oil prices.
Yeah.
So there is an understanding. How long that tolerance will last is kind of the question mark.
Yeah, exactly. And then of course you have to segment all of this to answer the second part of your question. Yeah, which country, which income group, etc., etc. And I think that's what we said earlier in this room too. Yeah, that you know, depending on what population you're looking at, there will be people who will be priced out of flying, and that, you know, clearly different prices and different relative prices will affect people's choices, you know, depending on what their alternatives are, which depends on where they live and where they're trying to go. So, you know, consumer behavior will for sure change in response to this, but it's, you know, difficult to say that, you know, in a blanket kind of way, yeah, that, you know, people everywhere are going to behave in this, in way X, you know. I mean, people will behave in way X, Y, Z, depending on who they are and on their income level. But generally speaking, it's of course very unfortunate, yeah, for the democratization of air transport that that we're in this situation. Yeah, what we want for the global economy and for everybody in it is cheap and fast and sustainable transportation for everybody, all modes of transportation, including, of course, air transport.
Okay. And with that, we have time for one last question. Who wants the last word? Maybe in the front row.
That's okay, thanks. My name is Steve Goldstein, I'm with Syrium. Question about your scenarios. Did you take into account the war in Ukraine when developing your scenarios, which is now going on 4.5 years? And going back to that time, did you have sort of like what was your assessment 4.5 years ago about that war? What was your base case then? Thank you.
Yeah, difficult question to go back that long. Yeah, in answer to the first question, yes, this takes into account all the current market conditions and all the historical market conditions. So the outlook for the Russia-Ukraine war. Back then, honestly, I can't answer exactly what we predicted at that time because we do our forecasts every month. So we would initially have probably expected a shorter than the 4.5 years that we're looking at now, ongoing. And then later, when it seemed obvious that it was going on longer, we would have adjusted that.
All right, and with that, I think we'll call this briefing to a conclusion unless anybody has a last comment they want to make. Excellent. Good. Well, thank you all very much. The CEO panel is about to start upstairs. You're welcome to join us for that, and then we wish you a good rest of the day. Thank you.